We started terminologies in relation to VAT, and we stopped
VAT.
at vatable period. That's the
Okay.
III.
Okay, we stop at vatable period.
Yes.
Okay. The third one. Okay, this is where we stop. Okay, thank you. Yeah, okay, yeah. I think I remember now. Yes. So, yeah. So as we started in our last class, we started with value-added task, where we made mention of that I told you that value-added task is what? It's a tax on consumption. This is charge on what? On consumption. So that means you are only going to pay the tax when you consume certain goods and services. So if you don't consume those goods and services, the tax will not be what? Payable by you. And normally, the burden of this tax is usually shifted to the final consumer. It is the final consumer who is going to bear the burden of the tax payment. So we made mention of various aspects under VAT. So where I told us of the definition of goods, and we also look at the principle of VAT, where I told us that we have what? The origin principle and the destination principle. And I told us that in Nigeria, who can remind us which principle do we adopt in Nigeria? Which principle do we adopt in Nigeria?
Destination principle.
Yeah, destination principle. Only goods and services that were consumed in Nigeria will be liable to what? To VAT in Nigeria. So we started with some terminology. So where we stop at the third one, which is vatable period. And I told us that vatable period is a period of what? 1 month, starting from the beginning of the month to what? To the end of the month. After vatable period, the next thing we have is we have what is called input VAT. Input VAT. So input VAT is simply VAT you are what? You suffered on purchases. All VAT that you suffered when you purchase the item you want to sell is called what? Input VAT. Because the item you want to sell is not going to what? It's not going to come from heaven. You're also going to get it from somewhere, whether the raw material or some. So any VAT that you suffered on those purchases that you make is called what? Input VAT. So in simple terms, input VAT are what? They are VAT on purchases. After output VAT. Output VAT. So that is the opposite. So those are the VAT that you collect from your sales. VAT collected from sales. So when you are selling those items that you purchase or those items that you manufacture, the VAT you collected from your customer is what is called what? Output VAT. So VAT from where? From sales of goods and services is called what? Output VAT. Then we have what? We have what is called what? VAT return. Before I talk about this refund, we have a VAT return. It is expected that what you call, I said when you said you are going to collect VAT, and when you buy, you pay VAT. So under here, that means you have a taxpayer, a vatable person is going to have two categories of VAT, which is what, both what? Input VAT and output VAT. The law gave you a right. Yeah. The law gave you a right. Yeah. So the law gave you a right to remove your input VAT from your output VAT. So where the output VAT is more than the input VAT, what you have is what you are expected to pay to the government. That is what you collect is more than what you suffer. So that means what? It is expected that you should pay certain amount of money to the government. So that is what is called VAT return. That is when the amount of your output VAT is more than your input. VAT return is what? Output VAT minus input VAT. So there is the difference will give you what you are going to pay to the government, which is the return, and which is expected to be what? To be remitted to the what? To the relevant tax authority, which is what? Federal Inland Revenue Service. We can also have VAT refund. When can we have VAT? That means when your input VAT is more than your output VAT. That means what you suffer is more than what you suffer in a month is more than what you collected in that particular month. That means you have paid more. So it is expected that you should get what? A refund. So that is called what? VAT refund. So, and that refund is usually what? Given to what? To the taxpayer through what? Through tax credit. It's given to the taxpayer through what is called tax credit. Then we have a taxable supply. So any transaction that is liable to VAT is what is regarded as a taxable supply. Any transaction that you are what? You are providing for a consideration and which will be liable to VAT is called a taxable supply. Then we have what is called VAT exclusive. VAT exclusive. So that word exclusive, when they say something is exclusive, that means it is not included. What that means is that the VAT amount is not included in the invoice price given to you. VAT amount is not included in the invoice price given to you. That makes it to be what? VAT exclusive. So when an item is what is given to you as VAT exclusive, what that means is that what you have only the invoice amount. So to calculate the VAT, you just calculate what the rate of the VAT of what multiplied by the invoice amount, which is what 7.5 divided by 100 multiplied by what the invoice amount. So that means what you are applying what the rate directly on what on the invoice amount. So that is what VAT exclusive. So the VAT amount is not included in the VAT amount, in the invoice amount. Yeah. Then why we may also have VAT inclusive. When they say something is exclusive, that means it is included in what? In the invoice amount. So that means the VAT amount is included in the invoice amount. So what that means is that instead of the invoice amount to be at 100%, the invoice amount is at 100% plus 7.5. That will give you 100 plus 7.5. That will give you 107.5. So to calculate the VAT now, the VAT will now be calculated at 7.5 divided by 107.5 multiplied by what? The invoice price, which is what? That is when what? VAT is inclusive. So the examiner will tell you whether what you are giving is what? VAT inclusive or VAT exclusive. But please, where the examiner is silent, where the examiner did not mention the nature of what? Of the invoice amount, you assume VAT exclusive. So take note of that. Where the examiner did not specify, we assume VAT exclusive. Then we have what is called the basic tax points. Then this determines the period in respect of which VAT is payable or reclaimable. That is, at what point are you going to pay the VAT, or are you going to start removing the VAT? Is the VAT become liable on you, or at what point are you going to claim back the VAT? So the tax point can be based on either goods or services. So if it is goods, so the basic tax point of goods is the date or the date the goods are removed. That is, whenever you buy those goods, you remove it from the supplier. When you buy the goods, where you have made payment for the goods, so VAT become liable on that goods. Then why on services? When that services is what is being performed, so VAT become what? VAT become liable. So that's what they mean by what? The basic tax. The basic tax. Then we also have an actual tax point, which is usually the invoice date. So the actual tax point. Sorry, as I was saying before the interruption, so we have what? Those are the tax points. Then the next thing we are looking at is what? Registration of taxable person. As a VATable person or taxable person, how are you expected to register? So any registration relate to what? Anybody that deals in what? VATable goods and services is expected to register for what? Value added tax. So this person can be what? It can be government agency. It can be government agency. It can be statutory board. It can be company. It can be individual in businesses. So not individual like you and I that are not in business, but individual that are running businesses are also expected to register for VAT. It can also be what? It can also be club, restaurants, any organization who trade or deals in VATable goods and services are expected to register for value added tax. Then also, so if you now register for the value added tax, so that means you are liable to collect value added tax and remit to the relevant tax authority. A non-resident company is also expected to register for value-added tax. So that means what? Any company that is not a Nigeria company are also what? Mandated by law to register for what? For value-added tax. But where that company does not have any office in Nigeria, so what the law says is that they are expected to what? To make use of what? Of the address of that person they are dealing with in Nigeria for the purpose of the registration. So a non-resident is not what? Is also expected to register for value-added tax. So once that non-resident will deal in what? Vatable goods and services. So that non-resident where they don't have an office in Nigeria, they are going to use the address of what? Of that person they are what? They are dealing with in Nigeria as well as the address for what? For registration. It can also be what? Government agency, statutory body, other agency and what? And other body are also what? Expected to register for what? For value-added tax. So registering for value-added tax, you are also expected as a vatable person when you register for value-added tax. So you are expected to what? The process of registration is that what? When you have various outlets, for instance, like all these company, like let's use Coca-Cola as an example. Coca-Cola, they have plants in Lagos, they have in Ogun State, they have in other state of what? Other state of the federation. Which means that what? Coca-Cola is going to be collecting VAT both in Lagos State and they will also what? Collect VAT in what? In other what? In other state of what? Of the federation. So according to the tax law, it is expected that that company, because they have various outlets, because they have various outlets, they are expected to register each of their various outlets separately with what? With the nearest Federal Inland Revenue Service that is closer to their office. What that means is that so Coca-Cola in Lagos will register with what? The nearest FRS office using a TIN number. Coca-Cola in Ibadan is also the same Coca-Cola. They are also going to register for VAT with what? With the FRS at Ibadan, with the same VAT, with the same TIN number that the Coca-Cola in Lagos adopted. Yeah? With the same TIN number that they are going to, that Coca-Cola in Ibadan, we also use the same TIN number that Coca-Cola in Lagos also used to what? To register. The TIN number will be the same, but what? They just need to register for what? For the purpose of what? Compliance and record purpose. So that's what the nearest office can be able to what? To monitor their payments and what? And the level of their transaction. So that does not mean that Coca-Cola in Lagos, Coca-Cola in Ibadan are doing various transactions. It is still the same organization, but they are going to register with nearest FRS office for the purpose of for the purpose of what? VAT, in order to what? To make it what? Easier for them. Because if the tax authority says, okay, because the head office is in Lagos, all transaction that is done in Oyo State should also be what? Transferred to Lagos. That will be what? That will take much time and what? It will be cumbersome. And it's going to be a burden on what? On those that are in Lagos. Because each of the location will also have what? Its own reporting accountant. So that is the reason why what? They must register what? Separately. So this is only applicable for what? For VAT, for the purpose of value-added tax. So that is what? That is in the case of what? Value-added tax. So the way they are expected to register, there is also what we call what? The registration for VAT. So there is what we call the registration for VAT. When a vatable person, when they cease operation, they are also expected to notify FRS that what? They are no longer what? Carrying on trade or business. And the law says that what? This information must be what? They must notify FRS within what? 90 days. Within 90 days afterward, after the date of cessation. So that means for any company that ceases operation and has been deducting VAT before, it's also expected by law to give that information to what? To Federal Inland Revenue Service that yes, we are no longer in business from so day, and this must be given to FRS within 90 days. Failure to what? To notify FRS within 90 days, we need to what? Penalty that should be what? That should be charged on the company. So those are the what? Those are the process of registration and the registration. Any question? Any question?
Please, sir, can you sorry, take that again? I lost that when you mentioned registration at different locations. From there, I didn't really hear you.
Okay. So what the law says is that what? When you have a company that is having various outlets in various locations, it is expected that those outlets should register with what? Nearest FRS office for the purpose of VAT. This is only applicable to VAT. They are going to register with what? With the nearest Federal Inland Revenue Office. You know, Federal Inland Revenue is a federal government tax authority that collects what? Money relating to what? To the federal government majorly, and some other income basically relating to the government. So, and they have what? They have offices in all the state of the federation. So if you have an office in Lagos now, you also have another office in Ibadan. You have another one in Benin. So what the law, as I was saying before the network logged me out, what the law was saying is that where you have various outlets, those outlets are expected to register with nearest FRS office for the purpose of VAT, in order to ensure convenience and easy filing of VAT return. But it is still the same company. That company in Ibadan, and that one in Lagos, and that one in Benin, they are going to use the same TIN number, because it is still a single entity. But they are going to file their return to various nearest FRS office for the purpose of what? For the purpose of convenience and return purpose. So that is what the law is saying about about the registration of VAT for VAT. So I hope that's answer your question. Are you okay with that?
Yes, yes, sir. Thank you, sir.
Record and account. Every VATable person, that is any company who deals in VATable goods and services, is expected to what? To keep proper record of what? Of the transaction. So when you are keeping the record, so you give what? So those record is called what is called tax invoice. So you keep record of what? Of the transaction involving VAT. And failure to keep that record is also an offense. So keeping that record, the tax authority expects you to have what is called a tax invoice, which should be what? Which should be issued to what? So that tax invoice now is what the tax authority is going to issue to what? To the VATable person, that yes, you have collected this amount of VAT from you, or you have deducted this particular amount of VAT. And this tax invoice is going to have the tax identification number, the supplier name and address, customer name and address, invoice number, type of supply, description of goods and services, the rate of any cash discount offer, total VAT payable, the date of the supply. All information relating to what? To the transaction will be issued by what? So when VATable goods and services is being introduced. Recently, the Finance Act introduced what is called what? VAT threshold. The Finance Act introduced what is called the VAT threshold. So what do we mean by this VAT threshold? So what this means is that it is not every business that is expected to what? To charge value-added tax, to collect value-added tax. So because under the categorization of company, we have two categories of businesses. We have small, medium, and large. It's either you are small, you are medium, or large. And small company, their tax rate is 0, in which they are not liable to payment of tax. So what the law is now saying is that any taxpayer, any taxable person with a taxable supply of 25 million and below are required not to charge what? Not to charge VAT. So the VAT threshold is that when your transaction in a year, when your total supply, your total sales in a year is going to be what? 25 million naira and below. It is expected that you are not expected to charge VAT. It is only those vatable persons that their transactions are above 25 million naira per annum, not monthly. So where their transactions are above 25 million naira per annum. It is those what? Those people that are expected to what? To charge and what? And file monthly return. So when you are now a vatable person, you are dealing in what? Vatable goods and services. But throughout what? Throughout the year, your transaction in last year, your transaction, all your transaction, all your sales is not up to 25 million. This year now, you are not expected to what? To charge what? Value added tax. So how do you now determine this threshold? Number one is that the taxable person who has made taxable supply of 25 million prior to introduction of VAT threshold shall continue to charge, collect, and what? Remit what? And file monthly return, even if it has not made 25 million taxable supply in the current year. When the law came, the law came in the Finance Act 2020. What the law now says that when you have before that 2020, in 2029, you have already made a taxable supply of above 25 million. In that 2020, whether you have gotten up to 25 million or not, you are expected to what? To charge VAT. Then the second one, a taxable person who did not attain 25 million taxable supply before 1st of February 2020 shall immediately commence to charge and remit what? Monthly VAT upon attaining what? The threshold. Where in last year, in 2019, you did not what? Your total sales did not get up to 25 million. What the law says is that in 2020, don't charge. But you continue to charge once you get to what? That's 25 million in 2020. Then number register, charge and collect, remit and tax and file monthly return to FRA at any time, even without attaining 25 million. The fact that you know that last year you did not attain 25 million, but you have already foreseen a business that, okay, there is a business that you are pursuing this year, and that business is going to be worth more than 25 million. It is expected that since you already have a projection that you are going to get up to more than that 25 million, you can what? You can start what? Charging for value added tax, irrespective of what? The fact that you are yet to what? You are yet to get to that what? 25 million naira threshold. So basically, so a taxable person who makes taxable supply amounting to 25 million and above within a calendar year is required to file monthly VAT return to FRA as part. So whose such supply are exempted from. So even if part or the whole of such supply are exempted from VAT. So if you are also, if those activities that you want to supply, even if those activities are activities that are exempted from value added tax, in as much as that activity exceeds 25 million, you are expected to what? To file what? Value added tax return. So that is what, yeah. So that is what the law says. So basically, what the law is saying is that only those businesses with turnover of 25 million naira and above are expected to what? To charge and what? And remit value added tax. What happened now? Are expected to charge and remit value added tax. So that does not mean that what? If you have foreseen that you are going to what? You are going to get up to more than you are expected to what? To charge value added tax. So a calendar year is what? A period of 12 months, beginning from the start of the year to the end of the year. So that's what. So let us look at this illustration one. Mr. ABC, a wholesaler, supplier of consumer goods, commenced business in January 2019. Look at it. By the end of January, his taxable supply amounted to 10 million naira. Furthermore, his taxable supply increased to 18 million in February and 26 million in March 2019. When will Mr. ABC be expected to register, collect, and file monthly VAT return? Look at it. If you look at this information, in January, his taxable supply is 10 million. That means he cannot charge in January. In February, its taxable supply increased to 18 million. It can also not charge in February. But in March, its taxable supply increased to 26 million, which is above what, the 25 million. So it's going to start charging for VAT from where? March 2019. So that is what FRA immediately attained the threshold of 25 million in March 2019. It's going to start charging what, that value added tax from March 2019, because that is when what we attained the threshold of what, of 25 million naira. If throughout that year it does not attain what, that 25 million, is not expected to charge VAT, unless if he has foreseen that what is going to what, is going to get a business that what, that will give him what, up to what, more than that 25 million. If that is possible, is expected to what, to start charging value added tax. Then the Finance Act also introduced what is called self-accounting provision. This self-accounting, this is applicable to what, to non-resident company and small businesses. It's applicable to non-resident company and small businesses, or those businesses that are what, that are exempted from payment of tax. If you are dealing, so what the law says that what, you are dealing with somebody, you are expected to self-account for the value added tax yourself. That's what they mean by what? Self-accounting provision. What does that mean? Is that what? If you are dealing with a non-resident now, who does not have what? Any office in Nigeria, they don't have what? Any presence in Nigeria, they don't have anywhere, any location in Nigeria. That means what? It is possible for them. The law have said what, they must register for VAT, but because they don't have any location in Nigeria, they may decide not to register for VAT. Where they did not register for that value added tax, you are dealing with them, the law expects you to what, to account for that value added tax and remit it to what, to the relevant tax authority. That is what they call self-accounting provision. That is what you will be the one to account for that. So I'm dealing, for instance, now I'm a Nigeria company, ABC Limited. So a company outside Nigeria, let's say XYZ PSC want to supply me, want to render services to me, and that services is vatable. But that XYZ PSC is not what? It's not a Nigeria company. The value of that item, let's say, is 1,000. XYZ is only going to charge me 1,000. So what the law is saying is that what? After that 1,000, me, ABC Limited, I'm expected to add VAT to that 1,000. So when I add VAT to that 1,000, that means the total value will now be 107.5. 1,007.5. So if I now want to remit to the foreign company, I'm going to remit only that 1,000 as the invoice amount. Then the value added tax on that transaction will be remitted by what? By that company that is what? Present in Nigeria. So that company that is present in Nigeria will be the one that will remit what? The value added tax. So that's what they mean by self-accounting. Or if I'm dealing with a small company now, I know that they are not expected to deduct. And me, I know that company is a small company, they cannot charge me VAT. So if I want to pay them, I'm supposed to what? To add VAT to that item and remit it to to the relevant tax authority. But when I'm remitting it, I'm not going to remit it with what? The same way with what? With my own value added tax. I'm going to remit it in a what? In a separate form that is going to be what? That is going to be created by what? By the relevant tax authority. So that's a form that is also for self-accounting self-accounting remittance, which should be what? Which is what? So it is, yeah?
I have a question, please. Okay,
Okay.
so the Nigerian-owned company, when they are now remitting to, or rather when they are making the payments to the non-resident company, is it in the payment receipt that they will now include the VAT in the payment receipt?
Yes, in the payment receipt. This is it. By the time the foreign company give you a receipt, the foreign company is an invoice. The foreign company not going to add VAT. Abi?
Okay, sir.
It's
Yes,
not
sir.
going to add. It's not going to add VAT to it. But you, when you receive the invoice, you too, you are going to record it in your own transaction. Abi?
Yes, sir.
It is at the period of record in your own record that you are going to add VAT to it. When you are recording it in your own record, you add VAT to that amount. So that is what self-accounting. Because that person cannot even though if you pay that VAT to that non-resident, that person will not remit it to what? To FRA, because it's not It's not a Nigerian company. So as a result of that, in order not to Not to give the money to a foreigner that is going to take the money away. So that is the reason why this self-accounting position is being developed. Then it is not all goods and services that are vatable. There are some goods and services that are exempted. So this is ICAN friends. So there is no time that ICAN will bring question on value added that they will not ask you to mention certain goods and services that are exempted. So please let us take note. So we have goods, we also have services. We are going to look at the goods first. What are those goods that are exempted? We have a basic food item. Look at that word, basic. It is basic, not when you go to hotel. That is not basic again. Food item that you went to the market, open market, to go and buy To go and buy your food item. So no VAT will be added to what to do. But where that item, where you are buying it, where you are not buying it from there, from the open market, it is not more basic food item. All medical and pharmaceutical products, because government, they want every citizen to be healthy. So all drugs and any product related to pharmaceutical products are also exempted from VAT. Books and educational material, they want the citizens to also be knowledgeable. It's also exempted from VAT. Baby products, they want more people in the country. Oil export, oil. In some area, you see oil export. It is not all export, it is what? Oil export, oil export. It is oil export. Then we have what? Newspaper and magazine, agricultural equipment and product, plant machinery and goods imported for use in export processing zone, provided 100% production of such company is for exports. Then plant and machinery and equipment purchased for utilization of gas downstream petroleum operation, tractor, plow, and agricultural equipment and implement purchased for agricultural purpose, fertilizer locally produced, agricultural and veterinary medicine, vegetable oil, motorcycle and their spare part, bicycle, corporate bond and security, life insurance. Then we also have commercial aircraft engine and commercial aircraft spare part, commercial and residential rents. Before the Finance Act 2020, rent is usually a problem. That usually bring problem between FRS and taxpayer. But the tax law has specifically exempted rent. So when you are paying your rent to your landlord now, it is not liable to any value added tax. So rent is exempted from payment of value added tax. So we also have services that are exempted. We have medical services. We have medical service. We have medical services. We have services rendered by microfinance bank and mortgage institution, play and performances conducted by educational institution as part of learning, all exported services, shared passenger transport services, which is made available for public use, like our BRT. So when you bought the BRT, you will see that in the price, no value added taxes included. Then we have a training and education organized by not-for-profit making organization. The tuition paid for nursery, primary educational, interest for loan, interest on advances, overdraft, airline transportation tickets issued and sold by commercial airline registered in Nigeria, hire rental or lease of tractor, plow, and agricultural equipment for agricultural purposes. So all these are exempted goods and services. As we have exempted goods and services, we also have what is called zero-rated goods and services. These are goods and services that are liable to VAT, but the applicable rate is 0%. There are goods and services that are chargeable to VAT, but the rates that are applicable on them are 0%. So one of them is what? Non-oil export. Any export apart from oil. You know, when we did exempted goods, we mentioned oil export here. Now, they now have 0 rated non-oil export. Why do we have that? We now have non-oil export because it is possible that part of the goods and services that you want to, part of the goods and services, you cannot talk that you want, part of the goods and services that you want to export, part of it may also be what? Part of it may also be goods and services that are liable to VAT. But because you are exporting them, they are going to be what? The rate will be what? 0%. Why? Because we apply what? Destination principle. Because that means that if you are exporting them, you are not going to what? It's not going to be in Nigeria. Because
We're not hearing you.
okay. Okay, I'm coming. Let me check. Okay, can you hear me now?
Yes, sir.
Okay, so what I was saying is that non-oil export, it is possible that what we want to export is what? Are items that are what? Liable to value-added tax. But because anything you export, that means it's not going to be consumed here in Nigeria. So, and we adopt what? Destination principle. That means anything that is being exported is going to be what? Is not going to be consumed in Nigeria. So that means it's not to be what? Liable to what? Value-added tax. So any export is what? Is going to be charged as what? 0%. Then we have what? Goods and services purchased by diplomats. So diplomats are those what? Are those individuals or are those citizens of another country that come to Nigeria to come and represent their country in Nigeria for the purpose of what? Trade and what? And cordial relationship. Like an ambassador from where? From other country, ambassador from UK, ambassador from France, ambassador from other country are diplomats here in Nigeria. So any item they buy are going to be what? Charged at what? 0%. In as much as what? They can what? Identify themselves as what? As a diplomat. Then we also have what? Goods purchased for use in humanitarian donor-funded projects. The humanitarian donor-funded projects are what? Projects undertaken by what? Non-governmental organization, religious, social club, recognized and not-for-profit making that are for what? Public interest. For instance, during COVID-19, all these were foreign company, UN, IMF, they brought what? They brought foreign aid. They brought what? Relief materials to Nigeria in order to what? To cushion the effect of what? COVID-19. Those relief materials, they may be items that are liable to VAT. But because what? They are being brought for what? Humanitarian donor by what? For the purpose of what? Humanitarian and public interest, they are going to be what? The rate of VAT will be what? 0%. So those are the items that are what? That are 0 rated. So those 3 items are items that are what? 0 rated. So you may be asked, what are the difference between what? Exempted and 0 rated goods and services? The major difference between exempted and 0 rated is that when an item is exempted, it means that what? No VAT is charged on such goods or services. That is, the seller does not have, cannot add what? Any VAT on what? On those goods and services. Then also, that means what? The seller cannot what? You cannot get what? Any what? Any input VAT. So you cannot claim any input VAT. Any input VAT on what? On exempted item. But where an item is 0 rated, what that means is that what? Those items are what? VATable. But the rate is what? 0. But you now have a right to what? To get a refund of what? Of any input VAT you suffered to what? To manufacture those items. Any input VAT that will be suffered to. So you have a right to get a refund of what? Of for under what of the input VAT under what 0 rated. So those are items that are what. So those are then we have a non-vatable activity. Our wages and salary. The wages and salary we collected from our employer. By the time he is paying, or he cannot say he's going to add VAT. So it is what? It is exempted from, also exempted, it's not vatable. So they are what? Non-vatable activity. So when you render, so the services you render to your employer, where he pays you what? Your wages or salary, is not liable to VAT. It's only liable to what? Payee, personal income tax. You also have a hobby activity, any activity that you are doing for the purpose of what? To as your hobby. Private transaction, house rent, commission on turnover, all those are what? Are non-vatable activity. Then for a business reorganization, business that is changing their business, so that is reorganizing, they also have what? So VAT is exempted in any what? Any asset employed in trade or business sold or transferred. So when a business is what? Is doing reorganization of business, so that activity is not going to be what? Liable to what? To value added tax. So that is not where I'm going. So where I'm particular about is what are the method of calculating value added tax liability? Method of calculating value added tax. Basically, there are 3 methods of calculating VAT. We have the invoice credit method, we have the subtraction method, and addition method. So those are the 3 basic methods. So invoice credit method. So invoice credit method, under this invoice credit method, so the seller is going to issue an invoice. The seller is going to issue an invoice. Then after issue an invoice, you will now add VAT to that invoice. After adding VAT, so the VAT he add to that invoice is what is called what? Output VAT. So from the output VAT, we also look at what is input VAT. So the suppression of what? Of the input VAT from the output VAT will give you what? The value added tax. So the suppression of the input VAT from the output VAT input VAT from the output VAT will give us what is called what? The value added tax. So what the invoice credit method means is that what? We are going to calculate what? Output VAT. We also calculate what? Input VAT. So we now remove the input VAT from where? From the output VAT to get what? The amount of what? VAT payable. To get what? VAT. So this method is what is adopted here in Nigeria. So this is the method that we adopt in Nigeria, where we look at what? Our input VAT and what? And the output VAT. So the difference between the input VAT and the output VAT will give us what? The VAT payable. So I also made mention of this, that what? Where your input VAT is more than your output VAT, that is what? VAT refund. So that means what? The taxpayer is expected to get what? A refund of what? Of the value added tax in that case. So where what? In situation whereby the what? The input VAT is more than the output VAT. But where the output VAT is more than the input VAT, is going to be what? VAT remittance. So you are going to remit to what? To the relevant tax authority. So that is for that. That is invoice credit. So in the exam, so where the examiner asks you to calculate VAT, so we are going to make use of what? The invoice credit method, which is what we adopt in Nigeria by calculating what? Output VAT and input VAT. Then why the second one? We have the subtraction method. So the subtraction method, as the name implies, this one involves what? Subtracting the purchases from the sales to arrive at what? At the amount of value added. It's a process whereby we subtract some purchases from sales. We say what? Our sales minus purchases. So that will give us the value added tax. So the value added is what we are now going to what? Apply the rate. We will now apply the rate on the value added tax to get what? To arrive at the value added amount. So under the subtraction method, we are going to supply our total purchases from the total sales to arrive at what is called value added tax. So after arriving at the value added tax, we now apply the rate the value added rate, which is 7.5 on that value added to arrive at the value added tax. So, sorry, the difference between the purchases and the sale will give you value added. So when you apply the rate, it will now give you what? The value added tax. When you have the same transaction on a normal day, the invoice credit method and the subtraction method will give you the same answer. On a normal day, where we have the same transaction, it's going to give us the same answer. Then where the third one is what? Addition method. So the addition method involves a situation whereby what? The reward for all factors of production are added together to arrive at what? At the value added tax. So now I want to ask you, what are the factors? Who can tell us what are the factors of production? Factors of production.
Is it
What are
labor?
Yeah, land. There are 4 in number. Land,
Land,
labor, each other one. Land, labor. There are 4 in number. So factors of production are land, labor, capital, and entrepreneur. Those are the 4 factors of production. So all the reward for all these factors of production will be added together to arrive at what? At value added. After that, you now apply what? The value added rate to arrive at what? At the value added amount. On a normal day, so these 3 methods will not give you the same answer. So this method B, subtraction and addition method, is not adopted in Nigeria. It's only the invoice credit method that we adopt in Nigeria. It is only when the examiner asks you to apply the subtraction or addition method that you are going to apply that method. So those are the 3 ways of calculating value added tax. Then when we now want to calculate this value added tax, how do we calculate this value added tax? Are we supposed to calculate it on our total to remove all our expenses from the sales before arriving at the value added tax? The Finance Act has made it mandated now that the value added tax is now strictly on cash basis. Value added tax is strictly on cash basis. That is, it is only item that you have sold that you can calculate, you can account for the value added tax. When an item is yet to be sold and you are yet to collect the money, so you cannot value added tax will not become liable on those items. Also for expenditure, we have 2 categories of expenditure. Expenditure can either be revenue expenditure or capital expenditure. So an expenditure can either be revenue or capital in nature. A capital expenditure, those are the expenditures that are incurred to purchase our non-current asset. Expenditure incurred to purchase fixed assets, to purchase assets that will last for more than 1 year. Purchase or non-current assets are called capital expenditure. Please, any input VAT suffered on capital expenditure will not form part of is not going to form part of the input VAT that will be deducted from where? From the output VAT. Take note of it again. Any input VAT suffered on capital expenditure is not going to be part of the input VAT that will be deducted from. It's not going to be part of input VAT that will be deducted from output VAT. Those input VAT will be added as part of the cost of the capital expenditure. We are going to add it as part of the cost of the capital expenditure, which will be available for what? For capital allowance claim. So we add it as part of the cost. So that means if you are going to claim capital allowance on it, you cannot use it as what? Input VAT again, which will become double. So what that means is that when you are giving any question and you are giving any non-current assets, so those non-current assets, the VAT on them is not going to form part of your what? Part of your input VAT. So let us take note of that. Why for revenue expenditure? Revenue expenditure are expenditure that are recurrent. Expenditure that an organization incur on what? On a daily basis, day in, day out. Again, expenditures that are frequent, they call them recurrent expenditure. Under this recurrent expenditure, we have two categories. We have those that are direct and those that are indirect. Please, only revenue expenditure that are direct to production, that are direct to the output, will be what? We form part of input VAT. Only revenue expenditure that are direct will form part of input VAT. The indirect revenue expenditure will be added, will be taken to what? To profit and loss as what? As an expenditure. It will be taken to profit or loss as an expenditure. To be
It's a bit too fast.
So it will be taken to what? To profit and loss as what? But the one that is direct. So what do we mean by this direct and indirect? For instance, a company, let's say a company that is engaged in, let's say an hotel. You know, for an hotel, they are going to incur certain expenditure. So one of the expenditure they are going to incur is to buy drink. They are going to buy drink because that drink is part of what? It's part of their major activity. That's what they are going to sell. They're also going to sell some item that what? Kitchen item, like food item, which they are going to buy. So those any revenue, any input VAT they suffered on what? On those drink is going to form part of the input VAT. That is what? Direct. Also, this company is going to, they are also going to engage the service of, let's say, they are going to engage the service of a consultant. They will have a consultant, which they will pay what? They will have an auditor. They are going to pay what? Audit fee to that one, auditor. That audit fee is not what? Is not direct to what? To their activity. Is what? Is an indirect expenditure. Input VAT on that audit fee is not going to what? It's not going to be added as part of what? Input VAT. That input VAT is going to be taken to what? To profit or loss. It's going to be taken to profit or loss. What happened? What do you want now? I'm coming. So it's going to be what? It's going to be added at. So you have to look at what? The nature of the business to determine what will be what? Direct and indirect. An expenditure may be direct to a company, and that same expenditure will be what? Indirect to what? To another company. So what, in essence, what the law is saying is that the only input VAT that will be deducted from our output VAT will be what? Revenue, direct revenue expenditure. Take note of that. It will be what? Direct revenue expenditure. When an item is also imported, those items are also what? Liable to VAT. So the Nigerian Customs Service will also charge what? Value added tax at the rate of 7.5% and remit to what? To FIRS. Then when you have, when there is what? Inventory, when there is stock, when there is inventory, opening and closing inventory, such must also be adjusted before what? Before calculating what? VAT. So when there is inventory, you are going to add the opening inventory and less the closing inventory from your purchases before what? Before calculating the value added tax. So when you are giving inventory in the question and they give you, so you want to calculate VAT. So you must adjust what? Your purchases with what? With the level of inventory. You add the what? The opening inventory and less what? Less the closing inventory from your what? From your purchases before what? Before calculating the value added tax. Then we have what? Where discount is what? Is given to customer. So you what? Before calculating the VAT, remove the value of the discount before what? Before you calculate VAT on what? On those items. So that means what? The value added tax will be what? Will be applied on what? On the what? On the real price, not on what? Not on what? On the amount with the discount. So that is what? With the discounted amount. So where a discount is offered for prompt payment, VAT is chargeable on what? On the net amount. So you remove the discount before what? Before you calculate the value added tax. Also, where goods are supplied on hire purchase, value added tax will be what? Will be charged on what? On the selling price, the cash price. So, and not on what? Not on the higher purchase price. So, all these are what? Are items to what? To be liable to what? So, to VAT. So, in essence, when you are giving a discount, eliminated before what? Before calculation of what? Of the value added tax.
Please, I have a question, sir.
Do you
Hello,
have a
sir.
question? Okay.
Yes, sir. So are you saying that higher purchase transactions are not vatable, or services or goods are not vatable?
No, that's under higher purchase. We have various categories. We made mention of higher purchase. When you did, there was it when we did a capital and we did something on higher purchase, where we talk of higher purchase price, cash price. There are different prices in higher purchase. When you want to calculate the VAT will be based on what? On the cash price, which is the real price of what? Of the goods and services, not on the higher purchase price. Not that it's not going to be liable to transaction on higher purchase are not. There are also transactions that are liable to VAT. But what value are you going to what? Are you going to apply the VAT? It's not going to be on what? On the higher purchase price. It's going to be on what? On the cash price. So that is what I said. So that is for higher purchase. Then we have what? All your VAT return. The difference between your input VAT and your output VAT is expected to be remitted to FRL on or before month. That means all your we have stated already that vatable activity are activity from beginning of the month to the end of the month. So let's say for January now, from 1st of January to 31st of January. So all the transactions for that January, you have on or before 21 February to remit that money to FRA. Failure to do that will be liable to penalty and interest. So that is what for the case of what? Remittance and what? And return. And when you are what? Remitting, you are going to what? You are going to give details of what? Of all that transaction to what? To the relevant tax authority. Then we also have what? The refund procedure. Like when your input VAT is more than your output VAT, there's what we call what? Refund procedure. That is, the tax authority is expected to refund. So it's either a true credit method. Credit method in the sense that you are going to use it to claim your future VAT payment. So anything you want to claim now, you are going to use it to claim what amount you are supposed to pay in further year. It can also be what? Through cash refund method. It can also be what? Whereby what the tax authority is going to give you a refund. So where it is what? It is established that what? There is a refund process. It may also be what? The combination of what? Of both what? Credit and what? And cash method. It can be a combination of all of them, whereby what? The tax authority may also say they are going to give you money, and also what? You also claim what? Part of it as well as a tax credit. So because you are a vatable agent, the tax authority, they have what? They have a right to what? To come into what? Into your organization to come and carry out what is called VAT drive. They can come to your company periodically to check your what? Your level of compliance with the VAT deduction and remittance. So they are not going to give you any notice. They will just come to your company and say they want to check your level of your VAT compliance. So that is called a VAT drive. So the law gave tax authority that right to carry out that process. They also have a right to carry out what is called VAT audit and an investigation. They can also carry out what is called audit and investigation by writing you a letter that they want to audit your record for certain period of time. Usually, they can go back as far back as 6 years to say they want to audit the record of a tax payer. So which is VAT audit and investigation. Then we have we also have how is this VAT money shared? Because the money does not belong only to the federal, because the fund is collected by FRS only. After FRS have collected, it will now be shared to among the 3 tiers of government. So the federal government is going to take 15%, State government will take what? 50% and FCT, while 35% will be shared to the local government of the federation in what? In the various what? Sharing formula. Then if you have any dispute about what? Any amount of VAT charged on you as a vatable person, you have a right to what? To appeal to what is called a VAT tribunal. This VAT tribunal is like a court. It's located in various zones. So presently we have 8 tribunal in Nigeria in different zones. We have one in Abuja, in Lagos, Abuja, Ibadan, Enugu, Port Harcourt, Jos, Maduguri, and Kaduna. They are the ones that will look into what? VAT matter. They will look into the VAT matter and what? And come up with what? With the various what? The various what? Decision between on dispute on VAT between what? The relevant tax authority and what? Tax between the relevant tax authority and the so if you have an objection as to the amount of VAT expected of you to be paid by the relevant tax authority, you are going to write to the VAT tribunal and what you are paid. That's what. So then the VAT tribunal will now invite both the tax authority and the taxpayer. So the taxpayer has a right to be represented by a consultant. The taxpayer can go by himself, or he can ask his consultant to represent him for the purpose of the tribunal. Then we also have the VAT technical committee. There's a committee in charge of that look into matter requiring professional and technical expertise. So members of the technical committee are the chairman of the FIRS, which will be the chairman, or director, a director of Nigeria Customs Service, and 3 representatives from the Joint Tax Board, and the legal advisor. So 3 representatives from the Joint Tax Board and the legal advisor. We also be a member of the VAT technical committee. So then, what are the functions? To consider all tax matters that require professional and technical expertise, and to make recommendation to the board, to advise the board on its duty as specified in the Act, to attend to all such other matters as may from time to time refer to it. Then, organize meeting of technical importance on VAT. So anything requiring technical importance on VAT, so they are the one that will seek to such matter. So as the technical committee. So then we also have offenses and penalty, which are also stated in the material. So there are various offenses and various penalties that are applicable as far as value-added tax is concerned. So we have various offenses and various penalties that is applicable to various tax to the taxpayer. So and the offenses differs. So depending on the offenses committed by the taxpayer, determines the offenses that. So failure to register. If you are a taxpayer, which the law says you are a vatable person, you didn't vatable goods and services. The law has stated that you are failure to register. Then you now fail to register. Failure to register is an offense which is punishable. So in the tax law. So there is that. So failure to register for VAT, penalty of 50,000 naira in the first month, and then 25,000 naira in the subsequent month for which the failure continues. So will be the offense, will be the penalty, and so we have all the penalty and offenses as stated. Yeah, so I will employ. So let us look at those penalty and offenses. So you may also be asked. So the examiner can also ask also the penalty that is applicable to Ghana. That was a diet where they asked for what? Penalty. So I think the penalty for failure to register for tax purposes. So you may be asked for failure to register for value-added tax. So 50,000 in the first month and 25,000 in subsequent months in which the failure continue. Then so we have the advantages and disadvantages of value-added tax. So before we go, we are going to look at an illustration. So which is the first question, question number 1. We are going to look at that to illustrate. So we are going to make use of question number 1 to illustrate. So today, so we have the question number 1. So we have the following transaction took place. Yeah, the following transaction took place during the month of June 2020. The following transaction. So what are those transactions? We have what? AB Limited supply raw material to OB Limited for 500,000 naira. OB Limited used the raw material to produce goods and sold them to SY Limited, a wholesaler, for 700,000 naira. SY Limited in turn sold the goods to a retailer, JT Limited, for 800,000. JT Limited sold the goods to the final consumer for 850,000. Sorry, I'm coming. So require compute the amount of VAT payable to FRA. So VAT. So according to the VAT law, VAT will be charged at each stages of what? Of the distribution of this product. And the final burden of this VAT will be borne by what? By the final consumer. It is the final consumer that will bear the final burden. As I told us that in Nigeria, we adopt what is called what? The invoice credit method. That means we must calculate what? Output VAT and also calculate our input VAT and look for what? The difference between what? The output and the input VAT. So in calculating our output VAT, so we have to look at, so we have what? So because we don't have, so we have computation of VAT payable. So first thing is to calculate our output VAT. Output VAT, those are VAT charged on what? Collected on what? On sales. When we are selling, any VAT we collect is what? Output VAT. Then we have what? The first transaction, we have AB Limited supply raw material to OB Limited for 500,000 naira. So, and I also told us earlier that where the examiner did not tell you whether VAT inclusive or exclusive, what do we assume? Who can remind us? Where the examiner did not specify whether VAT inclusive or exclusive, what do we assume?
Exclusive.
Yeah, we assume it is VAT exclusive. We assume it is VAT exclusive. So we have what? AB Limited supply raw material to OB Limited for 500,000 naira. That means AB Limited is selling item to another company, OB Limited. So AB is, so there is going to be what? Output VAT collected by AB Limited on this transaction. So under output VAT, we have AB Limited. Since it is what? VAT exclusive, we are just going to say the rate of the VAT, 7.5 multiplied by 500,000. That will give us what? 37,500. 7.5 multiplied by 500,000, that will give us 37,500, which is what? Which is for the output VAT for the one sold by what? AB Limited. This same transaction, the person buying it, that transaction is going to be what? A purchases to OB Limited. That means to OB Limited, that activity is going to be what? Input VAT to OB Limited. It's going to be an input VAT to OB Limited. It is still the same transaction. So under input VAT now, that same activity, OB Limited, under input VAT, that same activity will now come as what? Input VAT, 37,500. The same transaction is going to give rise to what? Both input VAT to OB Limited and output VAT to what? AB Limited. After OB Limited bought that item from AB Limited, we are now told that OB Limited used the raw material to produce goods and sold them to SY Limited, a wholesaler, for 700,000. OB also sell it to another company, SY Limited. So that means that transaction is also going to give rise to what? To both what? Output and input VAT. So the one sold by OB Limited is going to give rise to what? Output VAT, 700,000 OB Limited is selling 700,000 at 7.5%. That will give us 52,500. This same transaction is going to become input VAT to SY Limited. For SY Limited, it's now going to be input VAT. SY Limited will be 7.5, 52,500. Then after that, SY Limited, which is the wholesaler, now in turn sold the goods to a retailer, JT Limited, for 800,000 naira. Is now selling it to a retailer. That retailer too, SY Limited, is also going to collect what? Output VAT, 800,000, 7.5 or 800,000, 60,000. So JT Limited, that transaction will become what? Input VAT, which is what? 7.5 of what? 800,000, 60,000. Then JT Limited now sold it to the final consumer. That means JT Limited is only going to collect output VAT. The final consumer has nobody to ship it to. It's the one that is going to consume it. It's now going to bear what? The final burden. So that means JT, that this one is only going to give rise to what? Only output VAT. So JT Limited is selling to consumer 850,000. JT 850 at what? 7.5 times 850. This will give us 63,750. It's not going to give rise to what? To input VAT. So that will give us some. So we now add up the totality of all this output VAT. That will give us 213,750. The totality of all the input VAT will give us the totality of all the input VAT. The totality of all the input VAT will give us what? 150,000. So which is what? The totality of all the input VAT, which is 37,500. It's not your money. 37,500, 52,500 plus 60,000. We give us so we give us 150,000. So the totality of those information will give us that I'm coming now. I will come and attend to you. Yeah, sorry, I will come and give us what? That's amount. So when you now add the total of the output VAT, that will give us what? 213,750. Then when you add the total of the input VAT, and we said when we deduct our input VAT from output VAT, that will give us the VAT payable. So VAT payable on this transaction will now be what? 63,750. It will give us what? 63,750, which is what? So this transaction will give rise to what? VAT of what? 63,750 naira, which is what? The VAT payable on what? On the transaction, which is, so that is what? That is how to. So because this is a transaction that gives rise to various VAT amounts, so that is the reason why we have a VAT as well. Various stages of the distribution, from distribution to what? From manufacturer to the wholesaler, from the wholesaler to the retailer, from the retailer to what? To the final consumer. At each of the stages, VAT will be charged, but the final burden will be what? Will be borne by what? By the final consumer, which is what? 63,750, which is what? The question we are going to. So that is the question we are going to. So we are solving today. So which is the first question? So